Our next guest is going for Goldilocks in 25, predicting that it will be a year of above-trend growth. He still sees some opportunities in Microsoft and Qualcomm. Eric Knutzen, Neuberger, Berman, multi-asset class CIO, joins us this morning. Eric, great to have you. Thanks for the time.
Oh, thank you. Great to be here.
We can talk a lot about rates and even earnings growth, but you sort of center in on how important the tech CapEx cycle is going to remain this year, right?
Absolutely. We do anticipate above trend growth, and our expectations for GDP growth are above consensus. We think we'll see 2.3 to 2.5% real GDP growth in the U.S., and that in an environment where inflation continues to be reasonably well behaved. We think inflation trends down from here from, say, the 3.3% level we're at now to 2.7, 2.8 in the first half of the year to 2.5 by the end of the year. That's a pretty supportive environment for equities and growth assets. It's 4.5 to 5% nominal growth. And that's why we remain constructive on equities. Frankly, we'll own the Magnificent Seven. They're great companies, but we actually see opportunity away from the Magnificent Seven towards the rest of the market that can really benefit from this higher nominal growth environment.
We just mentioned yields a minute ago. Does this return to the levels on the 10-year from last spring concern you in any way?
Well, I think the chart you just showed is the key chart. And one of our key themes this year is that attention of fixed income investors and really global investors is going to move away from this obsession with central bank policy and what happens on the short end of the curve and move to a focus instead on fiscal policy and overall policy around tariffs, regulations, et cetera, and that means that volatility is moving from the short end of the curve to the long end of the curve. And this concept of term premium we think is very important because we do feel that the 10-year Treasury, we say fair value on the 10-year Treasury is, let's say, 4.5, but it could trade anywhere between 5 and 4 this year. And that implies that even as inflation comes down, that term premium is going to be higher on the long end of the curve. At the same time, our fixed income team would point out that really the 2-year Treasury yield is capped at, say, 4.5%. There's not going to be that much volatility there. And that's what's going to really give markets volatility this year is how policy expectations translate into the long end of the curve.
I'm so glad you liked the chart and you summarized it really well. I do wonder what the long-term implications, though, are for stocks if we do see higher and more volatile long-term yields.
We've seen that stocks can handle yields at this 4.5% level. You see it rally, markets are rallying today, yesterday, even after rates have risen. Certainly, if yields go above 5%, that's problematic. And if they rise towards 5, that's going to cause some agita in markets. But if, as our economic forecasts expect, we stay in this range between 4 and 5% in yields, that will actually create an opportunity both to trade treasuries within that range, but also to take advantage of that volatility and use, short-term sell-offs associated with rate rises to add to exposures in equities and other risky assets.
Finally, we mentioned the opportunities you see in Microsoft and Qualcomm, but it extends to Alphabet and Amazon and Cisco. Benefits from another upgrade on the street today?
Well, we would say those stocks are, and I'm not the person at Neuberger who focuses on individual stocks, but we'd observe that the Magnificent Seven stocks are magnificent companies but they're fully valued. So while we do want to have exposure to those companies in our portfolios, we do see the opportunity away from those companies that we think are fully pricing in kind of the good news that is out there and want to look elsewhere in the market where we think that valuations are better down the cap spectrum, smaller company stocks. And we observe this dichotomy where high yield spreads are at kind of secular tights at the same time that, small cap stocks have been underperforming and relatively, more attractively valued. And that we think creates some interesting opportunities away from the Magnificent Seven stocks.
Yeah.